The Precious Metals Week in Review, February 12, 2016. Brought to you by Precious Metals International. U.S. and European stock markets continue to suffer this week as poor economic data, fears over the state of the European banking system, and a continued decline in the price of oil due to ongoing massive oversupply all kept stock investors on edge. Monday will be a holiday in the U.S., so U.S. stock markets will be closed at the start of next week as Asia begins trading again following its week off for the Lunar New Year holiday period. The number of Americans filing new claims for state unemployment fell by 16,000 claims last week, which was considerably more than expected. The previous week's data remained unrevised. The new level for unemployment claims after last week's decline was 269,000, which places the number of unemployment claims back near its lows for the cycle. Despite the better-than-expected unemployment data, U.S. stock markets were little moved as oil and the uncertain state of the global economy overshadowed the unemployment data. U.S. Federal Reserve Chair Janet Yellen testified in front of Congress this week, and she seemed to give the appearance that she was somewhat unprepared for the barrage of questions and antagonistic attitudes of many of the committee members. As stock prices have plunged, projections have been increasing that the Federal Reserve will be trapped into implementing further monetary stimulus rather than being able to follow through with its desire to begin regular interest rate hikes. Ms. Yellen's comments to Congress this week did nothing to alleviate those concerns. According to Kyle Bass, the founder of Heyman Capital, which is based in Dallas, Texas, a credit crisis in China would trigger losses for the Chinese banking system that would be over 400% larger than those that hit U.S. banks at the height of the subprime mortgage crisis that triggered the global financial crisis. Mr. Bass, in a letter to investors on Wednesday, said, "Similar to the U.S. banking system and its approach to the global financial crisis (GFC), China's banking system has increasingly pursued excessive leverage, regulatory arbitrage, and irresponsible risk-taking. Banking system losses, which could exceed 400% of the U.S. banking losses incurred during the subprime crisis, are starting to accelerate." Mr. Bass went on saying, "China's system is even more precarious when we realize that even at the biggest banks, loans are not made to borrowers based on their ability to repay. Instead, loan decisions are political decisions made by the state." Mr. Bass believes that heavy losses in the Chinese banking sector will force Beijing to recapitalize banks and trigger a massive devaluation in the yuan approaching 30%. In Japan, a plunging stock market and recently rising yen are both acting against Prime Minister Shinzo Abe's Abenomics plan, which relies on a weaker yen to aid in boosting Japanese corporate earnings and supposedly help generate higher import prices, which would aid the Bank of Japan (BOJ) in hitting its 2% inflation target. The yen surged to 15-month highs against the U.S. dollar on Thursday amid a weakening global economic outlook. Prime Minister Abe reportedly held a meeting with the BOJ governor and another top financial advisor on Friday to discuss ways to address the recent stock market routes and globally pervasive slowing economic growth. In Europe, passport-free travel across the so-called Schengen area may be coming to an end. Since 1995, people and goods have been able to cross the borders of the Schengen area member countries without stopping for document checks, allowing for freer and rapid movement of trade, goods, and labor. The escalating migrant crisis is on the verge of changing that, according to documents the Associated Press (AP) claims to have seen. According to the AP, the documents show that EU policymakers are preparing to make unprecedented use of an emergency provision by declaring that Greece is failing to sufficiently protect its border. The AP article notes that there is an emergency provision in the Free Travel Agreement which allows each of the 26 countries that currently make up the Schengen area to unilaterally put up border controls for a maximum of 6 months, with a possible extension of up to 2 years if any member is found to be failing to protect its borders. Greece is a member of the Schengen area, and any official declaration that it is failing to protect its border means that every other member of the area could immediately implement border checks under the emergency provision. North Korea followed through with its plan to launch a satellite a day earlier than expected. The launch is widely viewed to be cover for further attempts by the North to develop a ballistic missile program despite the threat of additional sanctions by the United Nations Security Council. The launch occurred on Sunday, just as China and South Korea began their Lunar New Year holiday celebrations, and the timing of the launch to coincide with the holiday kickoff might be viewed by China as a diplomatic embarrassment. Crude oil prices continued their decline this week, falling into the mid-$20 a barrel range as the global supply glut increased. The energy minister for the United Arab Emirates supposedly made comments this week indicating that OPEC was now willing to talk with other oil exporters about cutting production. The rumors sent oil prices surging higher on Friday as traders made bets that the discussions would actually take place. Another record-breaking polar vortex is set to make an appearance in the northeastern U.S. over the weekend, and that also may have helped boost oil prices on Friday as demand for heating oil picked up. The euro began the week with a slight dip against the U.S. dollar, from which it quickly recovered. The euro trended higher through most of the week, with a noticeable drop late on Wednesday during Fed Chair Janet Yellen's congressional testimony. The euro quickly recovered from Wednesday's dip, but had peaked by late Thursday and began declining into Friday. Despite Friday's decline, the euro will still close the week higher against the U.S. dollar. The Japanese yen started the week with a brief dip against the U.S. dollar, but soon began moving higher and continued that trend all week. The yen saw a slight decline into Friday, but will also close the week higher against the U.S. dollar. Next week will be another short trading week in the U.S. stock markets due to the observance of the President's Day holiday on Monday. This means that U.S. markets will not be open to react to any moves in the Asian markets after they reopen on Sunday night, following the Lunar New Year holiday period. China will essentially see 2 days of stock trading before the U.S. markets open again and can react. The past week has been short on economic data out of Asia due to the holiday period, but the continued plunge of U.S. and European stock markets, coupled with the ongoing slide in the price of crude oil, could act to trigger sell-offs in the Asian markets when they reopen. Japan's move to negative interest rates has sparked concerns that other central banks around the world may move to competitively take rates into negative territory and trigger rapidly escalating currency wars. Sweden's central bank, the Riksbank, exacerbated those concerns on Thursday when it said it was moving its interest rates even further into negative territory, moving to negative 0.50% from negative 0.35. The Swedish central bank also said that it would reinvest money from maturing bonds and coupon payments, essentially expanding its quantitative easing program. The Swedish crown plunged in response to the news. Fears are also growing that the ongoing slide in oil prices could trigger an avalanche of non-performing loans to the energy industry at banks, in much the same fashion that plunging home prices triggered a massive surge in foreclosures at the start of the financial crisis. Media personalities and analysts alike have all begun discussing the possibility of another global financial crisis, triggered by ultra-low oil prices and a slowing global economy. Such a crisis coming when the world's central banks have basically run out of ammunition to be able to address yet another economic and banking crisis on the heels of the Great Recession could spell disaster for global stock markets once again. Rumors that OPEC might be considering production cuts in order to boost oil prices are just that, rumors. Supposed remarks by the energy minister of the United Arab Emirates that OPEC is open to discussing production cuts have yet to be seriously substantiated. The spike in oil prices on Friday was likely just short covering ahead of a long weekend rather than any serious and sustainable rally in oil prices. As we move into another long weekend, it will be vitally important that you monitor global news outlets for market-moving events, particularly as Asia reopens its stock markets on Sunday night, following a week off for the Lunar New Year. Investors appear to be rekindling their interest in physical precious metals as a safe haven investment opportunity as global stock markets suffer massive spikes in volatility. This week's price moves higher in precious metals likely did not surprise those wise investors who have followed through on their plans to continue acquiring physical precious metals as part of a well-diversified investment portfolio, even as prices have remained suppressed. These same investors recognize that the time to make their precious metals acquisitions is before panicked buying sends the prices skyrocketing higher at an increasing pace. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products, and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, February 12, 2016. Brought to you by Precious Metals International.